The cash ratio is a financial metric that helps assess a company's liquidity by measuring its ability to cover short-term liabilities with its most liquid assets, cash and cash equivalents. Unlike other liquidity ratios, such as the current ratio or quick ratio, which include accounts receivable and inventory in their calculations, the cash ratio focuses solely on cash and cash equivalents. This makes it a more conservative measure of liquidity, providing a clear view of a company's ability to meet its immediate obligations without relying on the sale of inventory or collection of receivables. Cash ratio. The cash ratio is calculated by dividing a company's cash and cash equivalents by its current liabilities. To break this down, cash includes physical currency and money held in bank accounts. Cash equivalents are assets that can be quickly converted into cash, such as short-term investments or treasury bills. Current liabilities are obligations that are due within 1 year, including accounts payable, short-term loans, and other short-term debts. Example: imagine a company with $50,000 in cash and cash equivalents and $200,000 in current liabilities. To calculate the cash ratio: 1. Identify the cash and cash equivalents, which is $50,000. 2. Identify the current liabilities, which is $200,000. 3. Divide the cash and cash equivalents by the current liabilities, $50,000 divided by $200,000. In this example, the cash ratio would be 0.25, meaning the company has 25 cents in cash for every dollar of current liabilities. This indicates that, based solely on its cash and cash equivalents, the company has a quarter of the amount needed to cover its short-term obligations. Low cash ratio. A low cash ratio indicates that a company might struggle to meet its short-term liabilities using only its cash and cash equivalents. This situation can be a red flag for investors or creditors, suggesting potential liquidity issues or reliance on other assets to cover obligations. Companies with a low cash ratio might need to improve their liquidity management or explore additional financing options. High cash ratio. A high cash ratio suggests that a company is in a strong position to cover its short-term liabilities with its cash and cash equivalents. This typically indicates a conservative approach to liquidity management, where the company maintains substantial cash reserves. While this is generally favorable, an excessively high cash ratio may also indicate that the company is not effectively using its cash for growth opportunities or investment. How can companies optimize cash ratio? Improve cash flow management. Streamline operations to ensure that cash flow is stable and predictable. This includes optimizing collections, managing payables efficiently, and controlling operational costs. Reduce unnecessary cash reserves. While maintaining a healthy cash reserve is important, excess cash can be invested in growth opportunities or used to pay down debt. Companies should evaluate their cash reserves and adjust as needed. Enhance revenue generation. Focus on increasing revenues through better sales strategies, expanding product lines, or entering new markets. Increased revenue can lead to higher cash reserves and improve the cash ratio. Key takeaways. The cash ratio provides a conservative measure of a company's liquidity, focusing on the ability to cover short-term liabilities using only the most liquid assets. A low cash ratio can signal potential liquidity problems and a need for better cash flow management. A high cash ratio indicates strong liquidity, but may also suggest that cash is not being optimally used. Companies can optimize their cash ratio by improving cash flow management, reducing unnecessary cash reserves, and enhancing revenue generation. By understanding and managing the cash ratio effectively, companies can better navigate financial challenges and ensure they maintain adequate liquidity for their short-term obligations.